Welcome to the Deep Dive. Today we are jumping straight into, well, the pressure cooker of QSR turnarounds. We're looking at a major brand's Q4 and fiscal 2025 earnings.
Yeah.
And this report wasn't just a set of numbers. It was, I think, a really candid confirmation of some deep, deep challenges. It feels like a pivotal moment in their whole restructuring story.
It absolutely was. The print came out after the close on November 19th. And, you could feel the tension just in the market's reaction. The stock was all over the place.
And that's because the stakes are so high, right? Management is trying to pull off this massive restructuring plan. They're calling it Jack on Track, while fighting off rising costs and just trying to get customers in the door.
Exactly.
So our mission today is to guide you through all this complexity. We're going to break down the, frankly, messy Q4 results, dissect what this Jack on Track plan really means, and then look at the 2026 guidance.
And I think we really need to focus on this huge pivot they're making. The whole story now is about simplifying the business and paying down debt.
Right. It all comes down to this one question. Can financial engineering save a business that's, fundamentally struggling to grow traffic?
Well, let's start with that immediate snapshot, the headline numbers. Because the market got some serious whiplash trying to figure this one out.
It was a classic good news, bad news story. Or maybe okay news, really terrible news story.
Yeah, that's a better way to put it. The top line, the revenue, was actually a slight beat. It came in at $326.2 million.
Okay, so a beat. The street was looking for what, around 321, 322 million?
Exactly. So they cleared it. But, and this is the big but, even with that beat, revenue was still down 6.6% compared to last year.
Not great. But the real story, the real gut punch, was on the bottom line.
Oh, it was a catastrophe. GAAP diluted EPS, so that's the official profitability number, came in at just 30 cents.
30 cents. And the expectation was closer to 46 cents.
46 cents. That's a 35% negative surprise. I mean, that is a massive miss. And you look at it year over year, Q4 of 24 was $1.12. So we're talking about a complete profitability collapse.
And you see that everywhere. Net earnings fell to just $5.8 million. That was almost $22 million a year ago.
And the one metric everyone in this industry watches, adjusted EBITDA, it basically tells you how much cash the business is generating.
Right.
It dropped over 30%, from $65.5 million down to $45.6 million.
Wow.
That is the sound of a business model breaking under pressure. When your sales shrink even a little and your costs for things like labor and beef are going up, your profits just fall off a cliff.
And management was pretty blunt about it. They called 2025 a challenging year,
to put it mildly.
Yeah.
And they framed 2026 as a rebuilding year. So they're telling you not to expect any miracles.
So what was the root cause here? It all comes back to the stores, right? People just weren't coming.
That's it. System same-store sales were down a whopping 7.4% for the main brand.
And that includes both company-owned and franchise stores.
Yep. The franchise stores are actually a little worse, down 7.6%. And Del Taco, the brand they're now trying to sell, was also down almost 4%. I mean, these are just brutal numbers.
So what did they do? They said Q4 was a tale of two halves.
Right. They started the quarter and their value offers just weren't working. The consumer wasn't biting. So they had to pivot, and they had to do it fast.
And they saw a big sequential improvement after that.
They did. About 300 basis points. They shifted to what they call a barbell promotional strategy.
The barbell. So high-end premium items on one side and deep, deep value on the other.
Exactly. And it was the deep value that moved the needle. Specifically, things like the $4.99 bonus jack combo and the $5 smash jack.
Okay, so that got people in the door. That stopped the bleeding on traffic.
It did, which is job number one. But here's the dilemma. When you push those cheap offers, you crush your average check. You crush your margins. So the big question becomes, are you actually winning new customers, or are you just teaching your existing customers to buy the cheapest thing on the menu?
A very dangerous game.
Yeah.
And at the same time, they launched this big internal thing called Jack's Way. What is that?
Jack's Way is basically management admitting that their operations have gotten sloppy. Food quality, speed, order, accuracy, all the basics.
So it's reset.
It's total reset. And the most telling part is how they're restructuring their field teams. Those managers now have to spend more than twice as much time physically in the restaurants coaching people.
So they're admitting they lost touch with what was happening in their own stores.
Pretty much. They're trying to force a culture change from the ground up.
Okay, let's pivot from the stores to the balance sheet. Because this is where the moves get really aggressive really fast.
They have to be. In Q4 alone, they closed 47 Jack in the Box locations.
47. Wow.
And 38 of those were part of this planned Jack on Track program. So after a few openings, it was a net reduction of 32 stores. They're just ripping the Band-Aid off, closing the weakest units.
And that should help margins over time. But in the short term, margins got hammered, down 240 basis points to 16.1%.
Yeah, that's really tight.
Yeah.
And there were two big drivers. One was commodity inflation. No surprise there. Beef costs were up almost 7%.
Yeah.
The other was, ironically, the cost of growth.
What do you mean?
Well, they did this massive rapid launch in Chicago, 8 new restaurants in just 12 weeks.
And that's a brand new market for them.
Totally new. And the good news is they expect those stores to do over $2 million a year in sales each. So it proves the concept can work in a new city.
Okay, but what was the cost of proving that?
It was steep. The labor, the training, just the chaos of opening 8 stores that fast. It created a 130 basis point drag on the entire company's restaurant margin for the quarter.
Just from 8 stores.
Wow. Yeah. So you see this tension, right? They need to grow. But the short-term pain of that growth is immense, especially when the core business is so weak.
Which makes all the financial moves even more critical. They confirmed the Del Taco sale is on track.
On track to close in Q1 of 26. They're calling it a meaningful step to simplify the story. And it is. It lets them just focus on fixing the core brand.
And with that simplification comes a huge change in capital allocation.
The biggest one. They officially discontinued the dividend and all share buybacks.
That's a massive red flag for investors usually.
It's the ultimate "we have a problem" signal. It means all available cash has to go to one place and one place only.
And that is paying down debt.
Paying down debt, the #1 priority. Their main goal is to pay down a specific chunk of debt, about $263 million worth. That comes due in August 2026.
And they'll use the money from the Del Taco sale to do that.
Proceeds from Del Taco, plus some real estate sales they're working on. It's a pure balance sheet rescue mission.
Okay, so a ton of moving parts. How did investors react to all of this, and what does the guidance for 2026 actually look like?
The reaction was skeptical, to put it lightly. The stock popped a little at first, then just faded. The street is basically saying, this is a show me story.
I believe it when I see it.
Exactly. We saw a bunch of analysts immediately cut their price targets down to around $16. Nobody's giving them the benefit of the doubt.
So what are they guiding to for 2026? What are they asking investors to believe in?
The guidance is extremely cautious. For the standalone Jack business, they're guiding same-store sales to be somewhere between -1% and +1%.
Basically flat.
Basically flat. And they're saying Q1 will still be negative, with things hopefully getting better as the year goes on, partly because the comparisons get so much easier.
And they're still closing stores.
Oh, yeah. The cleanup continues. They expect another 50 to 100 closures in fiscal 26.
And what about margins?
They're guiding company restaurant margins to 17 to 18%. And that number already bakes in the assumption that beef costs are going to keep rising.
Okay. And the big EBITDA number?
225 to 240 million.
There's also the corporate overhead piece, the SG&A. It's pretty messy right now.
It is. It's guided lower for the full year because Del Taco is gone. But they warned it's going to stay high in the first half of the year.
Why is that?
They call it stranded costs. When you sell a division, you still have shared IT systems, corporate leases, things that don't just disappear overnight. They think it'll get cleaned up in the back half of the year.
So the whole story really comes down to execution. They have to close the Del Taco deal, they have to pay down that debt, and they desperately need same-store sales to turn positive.
It's a chain of dominoes, and any one of them could fail to fall.
All right, that brings us to our favorite segment. This is not financial advice, where we take everything we just talked about and spin up let's call it an outrageous but plausible trade idea. For entertainment only, of course.
Of course. So let's lay out the facets. The market is pricing this stock like it's going out of business. It's down, almost 70% in a year?
Yeah, distress-like levels.
Exactly. The operations are a mess. We know that. But the financial engineering part selling Del Taco, paying down that $263 million in debt, that stuff is going to happen no matter what.
It's not dependent on whether people buy more Smash Jacks in Q1.
Precisely. It creates a kind of artificial floor under the company. The balance sheet will get cleaner.
So you're not betting on the burgers, you're betting on the accountants. What's the trade?
The trade is to go long the standalone Jack-in-the-Box equity. The theory is that once the Del Taco sale is done and they officially announce that $263 million in debt is retired, the market is forced to re-rate the stock.
Because the risk profile just fundamentally changes overnight.
It becomes a less leveraged, simpler company. And that alone could cause the stock to pop regardless of the near-term sales trends.
But the risks to the actual business are still huge. You've got high beef costs, insane competition on value, California wage pressure. How do you protect against all that?
That's the hedge. You hedge that systemic risk by shorting a big, expensive, large-cap QSR competitor. Pick one that's trading at a high multiple and isn't a turnaround story.
Okay.
So if the whole burger sector gets crushed by inflation or a weak consumer, your short position makes money, which protects your long bet on Jack. It isolates your trade. This becomes a pure bet on the success of the financial cleanup, not the operational one.
A pure play on financial engineering.
I like it.
Okay, to wrap this up, this call laid out a very clear, if very painful roadmap. It's all about simplification and deleveraging.
Management is absolutely in prove-it mode for 2026.
And the fundamental question, I think, for anyone watching this story is this. Can that barbell strategy, sacrificing your margin to buy traffic, can it actually work long enough to stabilize the business?
Or will the drag from those promotions, combined with high costs in new markets like Chicago, just undermine the whole balance sheet repair project before it even gets going?
What's the metric you'll be watching most closely in Q1? Is it sales? Is it EBITDA? Or is it just a confirmation that the debt is gone? That's the question we want to leave you with.
A lot to think about.
For sure. Thanks for joining us on the Deep Dive. We'll talk soon.